Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here with us today. We got a lot of things to talk about, and by the way, Wilsey Asset Management is a proud investing partner of the San Diego Padres. But a lot of things to talk about today. As I said, we got the jobs report came out yesterday. Markets were closed on Friday, but they still had jobs reports. We'll talk about that. Also, the labor market, that includes JOLTS, which is a job opening labor turnover survey. We'll discuss that. And something very interesting we brought out was mutual fund managers that don't invest in their own funds. We're going to talk more about that. And with me, as always, is Chase. Chase, what do you got?
Well, good to be here, as always. And you want to join the show, you got a question about a particular stock, the economy, whatever it may be, give us a call, 833-288-0973. Again, that's 833-288-0973.
And also, too, I want to mention we do have the workshop coming up. I'll give you more details about it. But if you really want to understand more about investing, how to invest using fundamentals, the emotional side of investing really gets to you. That's why we do these workshops. The next workshop is going to be April 20th from 6 to 8 in Scripps Ranch. It is a free workshop. You will learn more than you ever learned before. And we have well over, I think, 1,200 clients now. And they just don't get emotional because of how we do things. If you understand how we invest our clients' money, this is a great opportunity to see in detail what we do. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And again, that's April 20th. It starts at 6 o'clock in Scripps Ranch. Well, let's move on to the jobs report, because given the concerns around the economy, I'd say the jobs report was a positive one. It wasn't too hot, which would provide evidence for the Fed to increase rates more than anticipated, but it also wasn't too far below expectations. And overall, it showed a softening of labor market, not a bad labor market. You got to understand the two differences there. Headline payrolls grew by 236,000 compared to the estimate of 238,000, but the big highlight came from the average hourly earnings, which increased just 4.2% on an annual basis. It was the smallest increase since June of 2021. For most of 2022, the annual gains were over 5%, with March being the peak at 5.9%. This is more evidence that inflation is becoming a smaller problem. Also, another highlight was the labor force participation rate again ticked higher to 62.6%, which was the highest level since pre-COVID levels.
And then for comparison, in February 2020, the labor force participation rate was 63.3%. So we still have some room to go there. But areas that led the way in job gains, again, of course, leisure and hospitality at 72,000. Healthcare and social assistance was another one at 50,800, and the government at 47,000. Leisure and hospitality still remains 2.2%, or 368,000 jobs below pre-COVID levels. And I was really surprised by this one, because I normally don't like to see government have a lot of jobs in the labor report. But I was shocked to see that it's still lower by 314,000 jobs, or 1.4% compared to pre-COVID levels.
That is amazing.
Yeah. There were also 4 declining groups in the report, as retail trade was down 14,600, construction was down 9,000, and manufacturing and financial activities were both down 1,000 jobs as well.
And when you step back and look at those, construction down 9,000 jobs, I mean, that's nationwide. Yeah. That is not a big decline. And I still hear a lot of people that are in construction very, very busy, manufacturing and financial activities. Now, I'm surprised that's combined. Was that combined?
No, they each lost 1,000.
Each lost 1,000. Okay, but even so, that is very surprising, manufacturing. And I know we looked at the ISM number, the PMI number, manufacturing and so forth, still above 50, which is...
The PMI for manufacturing is not above
47,
50.
Wasn't it?
Yeah.
It was 47. So again, that is still a positive, because it's not above a 50, which is growth. Below 50 is declining. only 1,000 jobs lost in manufacturing. That's not bad.
And the big thing, again, that we've talked a lot about on this show is you have to understand with manufacturing, what happened during COVID was everybody was buying stuff.
Right.
So you're buying stuff, you manufactured a lot of goods. I think that people kind of, I don't want to say overextended themselves, but that's where their dollars were going. So I think companies had to hire people then to actually produce a lot of that stuff. Now I think we've kind of seen a reduction in demand on the manufactured goods side. So then companies have had to pull back a little bit, and you've seen a contraction in the manufacturing sector. But gosh, I think it only makes up like 30% of our economy. Goods aren't as big as services.
And the other thing, too, on the financials, down 1,000 jobs, that's also surprising because I know they include mortgage brokers. I assume they would include realtors as well on the financial side. I'm not sure. I know mortgage brokers are in there, but also with the banking situation and tightening of credit, I'm surprised only 1,000 on the financial side. So, and this
especially you wipe out all Silicon Valley Bank employees.
Silicon, who's the other ones? Signature, and so. And who they work with as well. Mm-hmm. So it is surprising to only have a 1,000 decline. And I still say this is a good labor market. I don't expect to see, and actually I think we did say it, but unemployment did fall to 3.5%. So, I mean, we have a good jobs market. The next one we're going to talk about, too, is a JOLTS report. So let's talk
real
about
quick on retail trade as well. That was the big loser. I was actually shocked by this. Department stores actually added jobs.
Department stores did?
Mm-hmm. Wow. But the decliners came from like kind of home improvement stores and so forth.
Oh, like the Home Depots and the Lowe's, I guess.
And furniture stores was another decliner as well, kind of piggybacking off the idea of good manufacturing.
Right. And I think, and I was talking to a friend of mine who owns a business here that's in the furnishings and so forth, and he said they're really seeing a big slowdown. And I said, I people are still, they've got their jobs, they're still saying, you know what, and also too, they bought a lot of stuff during COVID. I mean, the furniture stores were packed during COVID. People going in there just spending the money. Well, now I don't need a new living room set. I don't need a new recliner. I've got this. So I think there's this slowdown that people it's not they're pulling off on the spending. They just don't need it. And well, I'm not going to waste my money if I don't need it. So I think you'll see an adjustment there for months to come where people just don't need new furniture.
I mean, it doesn't matter what type of business you're in. You're always going to have your booms and you're always going to have your troughs. But what happens is when that trough happens, now you kind of return to growth once things level out and things kind of get back to a more normalized type environment. So I think maybe this could be another adjustment year, but then perhaps in 2024, 2025, you could kind of see the good sector start to recover.
And the other comparison that they could do, which I don't know if everybody would want to do this, but a furniture store could actually do this, I believe, is compare their sales today to 2018, 2019. Because when you compare it to 2020, 21, it's like, wow, yeah, things are booming. So you may be back to and back in 2018, 19, everything was fine. Things are good. But compared to the boom, we're actually down. Let's talk about the labor market. And for that, we mean the jobs opening and labor turnover survey, also known as JOLTS. That number came in at 9.93 million. This was a fall of 632 job openings when compared to the month of January, and it missed the estimate of 10.4 million openings. This was the first time since May 2021 that job openings fell below 10 million. And while this may still sound concerning, there's still about 1.7 jobs available for every available worker.
And also, too, again, the big thing that I look back on is if we go to January 2016 to February 2020, it's a pretty good time for the economy. Most people are the economy's doing well.
Fine. We're all happy back then. No concerns.
Job openings ranged during that time period from 5.59 million to 7.59 million. So, yes, we've fallen below 10 million, but we still have a ton of job openings compared to where we were at in a good economy. The other thing that I wanted to point out was layoffs. They actually declined 215,000 from January to a level of 1.5 million. And oh my gosh, 1.5 million layoffs. It sounds terrible, right?
Mm-hmm.
But again, it's all relative at the end of the day. Looking at that same time period of January 2016 to February 2020, layoffs ranged from 1.59 million to 1.97 million. And again, overall, I got to say, this is a softening labor market, but by no means is this a weak labor market.
And we keep talking about this period that you've got to compare numbers to something that's comparable to. And again, comparing February 2016 to January 2016 to February 2020, everybody was happy then.
Yeah.
Everything's going along fine. We're all happy, no concerns. I don't want to say no concerns, but we weren't saying, I'm losing a job or the economy's doing this, or say no. We felt that was a good time. And when you compare those numbers, like the JOLTS report and so forth, take out the COVID situation, because that was a boom for we'll call it 12 to 18 months. You cannot compare to that. That was a one-time thing. We'll get back to that. You're going to forget about that. And also, too, when you compare next year's numbers to this year's numbers, back to normal again.
Well, and the thing that you got to look at is, you wiped out the labor market for a couple of months.
Yeah.
And then you had this massive growth because you had people regaining those jobs that were wiped out in such a short time period. And the thing I was going to say, too, that is so funny is when you look at, I'm going to say like the news and headlines and so forth, again, in that period, there was a time where there was layoffs of 1.97 million. I don't remember the news blowing it out of proportion like they do with, oh my gosh, you see Microsoft's laying off employees, and it wasn't a big deal because it was kind of within a normalized range. But now it's like we had such low layoffs for a couple of years that this seems so elevated, but in reality, it's really not.
and this is because the mainstream media does not do what we're doing right now and say, okay, yeah, we had these layoffs, but compare them to a period before COVID. And also like, well, no, it's not that bad. And you're right, they didn't talk about that in 2018, 2019, because it wasn't news. But the mainstream media makes it news and scares people. People think, oh, yeah, we're in a recession. Oh, everybody's getting laid off. No, it's not fine. Businesses are doing what they need to do to keep their business profitable. They have a lot of cash on the balance sheets. But why? And also, too, during COVID, a lot of businesses overhired.
Yep.
And unfortunately, some of those were remote workers were like, they're not really that productive. We don't need them. Let's just get rid of them.
Yeah. And the thing that I'm going to say as well is I'm going to say that I would not be surprised if job openings continue to fall and layoffs actually increase a little bit more, because again, we're reverting back to a normalized economy and a more normalized labor market, not this craziness that was happening during COVID and post-COVID in the short term.
Yeah, because you said here that the layoffs were, what were they for this period?
1.5 million.
1.5 million. So back in February, from the 2016-2020, they went as high as 1.97 million. So we'll call it 2 million. So it could go up to that. Can you imagine the media? Oh my gosh, all these layoffs coming up. Like, no, not really that bad. So, and what this does, and this is why we do the Smart Investing Show, is this prevents people from investing or going to a short-term T-bill. Well, I can get 5%. I'm just going to do that until things get better. Things aren't bad. And you're going to see, and I think for the right business this year, I think you're going to see some good returns come December 31st. And if you're afraid of watching the job market and thinking all these layoffs and how terrible that is, you're going to miss an opportunity come December 31st by buying the wrong companies or being a T-bill or in cash.
Well, no, I think this is exactly what we need because, kind of when we look at it's not on our list to talk about today, so just briefly talk about the ISM service number, which it missed expectations, and that spooked the market this week as well, but it was still above 50, and services, again, is a large part of our economy, and the thing is, things are slowing, but they're not necessarily falling off a cliff and we're going into this deep recession. But the reason that's so important is if we have enough data that, let's say all of a sudden the job openings was like 500,000. Right. I think the Fed would be like, ooh, we got to hike 50 basis points. That would spook the market even more.
Yeah.
And I think right now we could be entering, they call it like a Goldilocks type situation where if we can get enough of a softening but not a complete fall off,
right,
that'd be a ideal situation. And I think it's very possible.
Right. And a little off track here. People are afraid of the market because there are expensive things in the market. We do still see companies trading at 25 to 35 times earnings. That's just too high. And if you're messing around those companies, yeah, there could be a fall there. But there's other great opportunities in the market, and do not let this information from the mainstream media scare you about, the job layoffs and, this is terrible. They will only pick the negative side and not do a fair comparison like we did here, saying, wait a minute, step back to before COVID and do a better comparison.
And I will say this next week is quite interesting because we do kick off earnings season with the big banks on Friday. That could be very telling because financials have gotten hit obviously quite hard with the Silicon Valley Bank situation. If you start to see good numbers from the bank and good guidance going forward, I think you could see a nice resolution for the financial sector and also, maybe a lot of other stocks in there as well. But the downside is a lot of these companies, as you mentioned, that are again, overvalued,
right,
is if they slow down more than anticipated, that's where the stock gets hit because let's say you're expected to grow at 10% on your earnings and you're trading at 25, 30 times earnings and you come in and grow at only 5%, people say, oh yeah, but they grew. It's like, well, they're expecting a higher growth rate. That's why they have a higher multiple. All of a sudden, that multiple can't be justified with a 5% growth rate. That's where those big tech stocks get hit quite hard.
And I just wrote a post for next week, which was about Costco, and I don't remember all the details, but I do know a year ago that they were growing their sales at and these are approximate numbers. If you get the newsletter, you get the full numbers next week. But they were growing their sales at 12%. I believe now they grew at 2 or 3%. Yeah. And the stock is still, I think the stock's down about 20% from the high. But sales dropped about 400% or so. Yeah. So
the sales growth dropped, not
sales growth, right? So did I say sales drop? I'm sorry. Yeah, sales growth dropped.
That'd be pretty bad if your sales just dropped 400%.
Oh, that'd be terrible. yeah. Thanks for correcting me on that one. All right, well, let's move on. And by the way, we're going to open the phone lines. You want that unbiased, no strings attached, fundamental opinion about what you want to talk about. Got questions on investing. Got questions on a business equity stock that you own. That's what we're here for. We'll run down the fundamentals to see if it is a good time to invest in that company or maybe time to sell. Give us a call here, 833-288-0973. That's 833-288-0973. Well, Chase, I didn't want to talk about mutual fund managers. I knew there were a lot of mutual funds out there, but I was shocked to see how few managers actually participate in their own funds that they're managing. According to Morningstar, some 4,643 out of a total of 7,108 funds have zero manager investment.
Yeah, I just got to say, I think this is just crazy. And as much as people talk about different objectives and risk tolerance, we've always been a big believer that a good investment for us should be a good investment for our clients. Ultimately, I believe that everyone shares the same objective, the main objective that is when it comes to investing, and that is to make money. This, again, is why we actually invest in the same companies as our clients when we manage money. And it just, I don't know. I just can't believe it. And, I actually had somebody point out something on Facebook, and it was it's an interesting point. He said it'd be stupid for them to buy their own fund because then they would pay a fee. But I do believe, and we're not a mutual fund, so I don't know all the rules on it, but I don't believe a mutual fund manager can buy in a personal account what they're buying in the mutual fund because then they could perhaps front run it and you wouldn't be able to manage it the same. Right. So I think it is interesting.
Well, and why shouldn't they pay that fee? Or unless it's a very high fee, then no one should pay
exactly.
that fund.
The guy said, well, it'd be stupid for them to pay a 2% manage. And I'm like, 2%? And especially, I'm sure they get the institutional shares, which many times is, 0.4, 0.6%, somewhere in that range on a good active mutual fund. I mean, if you're getting retail shares, maybe, but I think they would at least get the deal of the cheapest shares available.
And also, too, many mutual funds have different classes of shares. They've got A shares, B shares, C shares, institutional shares, so that fund manager doesn't have to buy the most expensive fee shares. He could buy the institutional shares and pay, I don't know, maybe 40%. And many times they need, $1 million to get in those, so it's a much higher level for institution side. But the manager could put into that, and why are they not doing that? And that's one thing that, because when we talk about mutual funds, we're not big on mutual funds because of all the problems you have, net redemptions and window dressing, and that's another one I didn't even think about. I would not recommend anybody invest in a mutual fund that the fund manager's not missing. Yeah. Why would you do that? Where's he? I would have put my money where he's putting his money.
Exactly.
So it would make no sense to do that. And I think if I was in a mutual fund, I would want to find out where's the fund manager putting his money.
Yeah, and also too, I mean, let's say they're paying a 0.4% fee. I think it would be more work for them to try and invest somewhere else than just to invest in their mutual fund, essentially. And it just kind of complicate things, especially because I got to imagine there's a huge subset of rules when it comes. I mean, gosh, you look at you look at like accountants and so forth. Like many of them that work on that, they can't buy stocks that they're auditing. I'm like, I don't think a mutual fund manager should be able to buy stocks in a personal portfolio that they're taking many times billions of dollars worth of money to then put into these stocks. I mean, you could benefit from that indirectly, essentially. So I think that would be a rule that would be in place.
Right. And the other thing too, I mean, where are they putting their money? I mean, that would make no sense to me why you're managing this and you're putting your money somewhere else. About 95% of my liquid net worth, which does not include the business, is invested the same way as my client's money is. And I've done that for years. I don't own any real estate. It actually is in that portfolio, buying the same thing for my clients. And I've done very well over the years because we're on the same side. We're on the same side. We both want to do well.
Yeah.
I don't understand that. I was just shocked to see it was that high. I mean, I thought, there's probably some that don't do it, but gosh, that's more than half.
Well, and it's just, again, it comes down to this whole concept of asset allocation and risk tolerance. And I just got to say, I mean, we just are not believers in risk tolerance. Oh, I'm conservative. And all risk tolerance is, in my opinion, is it was a tool that was created so that people could sell different asset allocations to clients. And it was an easy way to do it. And it kind of puts the blame on the client for the performance of the advisor many times. You say, I'm conservative, and you only average, let's say, 3 to 4%. Well, and then the advisors come back and say, well, what did you expect? You're a conservative investor.
Right.
And it's just, I think it's really backwards a lot of times because you're kind of asking the client what they want, where in our opinion, we want to invest in good companies and then educate people why they're good companies, not say, you're conservative, let's put you in bonds. Well, again, we knew bonds were a terrible investment the last 2 years, but conservative investors loaded up on those and were loaded up on those because, again, the asset allocation model.
And we talk about risk tolerance. There should be a volatility tolerance because we define the difference when people come in, we talk about investing their money for them. We talk about the difference of risk versus volatility. They're two different things. And to say you're risk adverse, well, that's okay. I don't like to lose money either. But we're okay with volatility, which is just the up and down movements. If you're buying good quality, you don't have the risk, you have the volatility, and that's what we talk about, the education for people. Don't worry about volatility, and don't confuse it with the risk, which is people doing like, you got to be more conservative. Why? Because I'm investing for 10 years, so if I invest and this year I go down 10%, but next year I make 20%, why do I have to worry about that volatility? I'm going down the 10-year route.
Well, I mean, that's the big thing that I think is so important for people to understand is, again, you look 10 years down the road. I'm 60 years old. Are you not going to live to 70?
Right.
That's a pretty high chance you are. And even if you're 80, there's a chance you live to 90. If you're 90, there's a chance you live to 100. You're looking at such a short time period. And when you look 10 years down the road again, you're not going to care if you had losing years. Right. You're going to say, how did my money do over that 10-year period? And if you were in the bank or you were in T-bills or whatever and you made 3% per year, I think you're going to be pretty pissed off.
Right.
And especially the people that made 8 to 10%, you're saying, oh, gosh, I should have done that.
And it's funny, I did talk to a gentleman that became a client, I think it was last week, and he's like in his 70s. And I said, you'll probably live another 10, 15 years and no problem. He goes, what? I better live at least 25, 30 years. Don't say 10, 15. So we want to think about that, I'm concerned because I'm older. But then in reality, we do want to live longer. And we have many clients in their 80s, which are doing phenomenal. And it's just that, and if something does happen to you and you pass away earlier, we always talk about this generational wealth. Mm-hmm. We're trying to build wealth not just for you, but for your family as well, so that your family can do well. And so it doesn't stop once you pass away. It will continue on. And I don't think you'll pass away as quickly as you go on. And I think we have quite a few clients in their 90s now, more than I can count. So I'll put it that way.
Yeah, and I think, again, is when you look at it, I mean, I talk to people and they say, this money's for my kids. Well, if I was their kids, I'd be pissed off if it's just sitting in the bank because it's like, you could actually increase the value of that money. And, worst case, if you don't need that money and your kids inherit it down the road, maybe it is during a down period. Well, it doesn't really matter. You didn't need it during a down period, so that's where the risk would come into play if you needed to liquidate it, but you don't need to liquidate it.
No.
So, I mean, understanding how to structure your portfolio is very important, and understanding your liquidity needs is really what allows you to invest properly.
Right, and we've had many clients where they pass away, goes to the show, and they get to step up in basis, which is nice. So you're actually passing something along. Where if you just, I got to be careful here, so I'll put it in, I'm going to get a 4% CD. Wow, I'm so excited about that. No, that's terrible. Yeah. I mean, especially if you're going to invest in it, and you live another 10 years, that money would probably more than double unless you took money from it, and you pass to your children at a better estate tax or state tax. And
no state tax.
You got no state tax. You get the step up basis.
As long as you have less than the estate limits. But.
Yeah, that's why there are benefits to it. Yep. And as always, you got to check with your CPA, your tax attorney on stuff like that. But it's just there are benefits to it to grow that generational wealth. And it is there for you as well. So this is why, let me also say too, promote the newsletter, because this stuff we have it on newsletter. The newsletter is growing very rapidly. People love the newsletter because you can probably read it in about 5 minutes. And you can get a lot of different information out of the newsletter. I mean, other things we put in the newsletter this week. We did talk about the ISM services number, TikTok statistics, what's going on with TikTok. That's in the news a lot. We also talk about money movement, OPEC and oil prices, so many different things that you'll get from the newsletter. It is free.
I got to say, we also added in there how we got fact-checked on social media. And it had nothing to do with our post.
Well, I didn't bring that one up because that's probably one we will probably talk about today, because it is kind of crazy that we got fact-checked. We will explain to you how that happened, because it was way off base. And I really think somebody needs to check the fact checkers, because I don't think the fact checkers have a clue what they're doing.
And they don't even fix it. They just left it.
And it's a big thing across our picture on the social media. Like, this may be, what did it say? This may be unreliable information or some crazy
it's like
stuff.
Partially incorrect.
Yeah.
Or partially false or something.
Partially false. And it was on the JOLTS report. We got the information from the Bureau of Labor Statistics or from the government. I mean, just, so it's kind of funny. But anyways, you can get the newsletter. It is free. Just go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Go to the section right in the middle where it says newsletter, and just click on there, sign up for it, and you'll get the newsletter every Friday at 5 o'clock when it goes out. So, all right, phone numbers here, 833-288-0973. That's 833-288-0973. 0973. And let's talk about the workshop, because it is coming up in just a few weeks here. At the workshop, you're going to learn how you should be investing now, because as we talked about, people are kind of concerned about the economy, the labor market. We'll talk about that, how to invest now. Will there be a recession or not? We're going to discuss that and how to invest during these times. Are price fluctuations keeping you from investing? People saying, oh, things are up and down, up and down. I'm going to wait in the sidelines until things get better. No, learn how to invest with price fluctuations, and also, too, how proper financial planning can reduce your taxes. It is a free workshop, but you have to sign up for it. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And look forward to seeing you on April 20th at 6 o'clock in Scripps Ranch. All right, phone numbers here again, 833-288-0973. 833-288-0973. Let's go out to or down to Chula Vista and speak with Jim. Jim, you're on the Smart Investor with Brent Chase. How can we help you?
Nutrien, NTR.
All right. Do you hold that or looking to buy that?
Just bought 100 shares of it. Try to get your opinion before I get any more.
Okay, yeah. I was going to say, did you just buy it yesterday?
Couldn't buy it yesterday.
Thursday. Thursday. Okay, yeah.
Thursday.
Okay.
Yeah.
Well, let's take a look at Nutrien, symbols NTR, in the agricultural inputs industry. I've never heard of that industry before. Only about 1.3% short on it, so that's pretty good. Institutional owned 72%. Very good PE ratio. Good start here. 4.8 versus 6.6. Price of sales looks good. 1 versus 1.1. Price to book value, and this is tangible book value, 3.1 versus 21.7. And price of cash flow, 4.5 versus 6.3. Also has a very good PEG ratio of 0.8 versus not material for the industry. So I like a good start here in the valuation ratios. Looking at the growth, well, good start here as well. 82% growth on the year for the earnings versus 37.5 for the industry. Sales growth up 23.4 versus 16.5. That's a positive. 5-year earnings per share estimated growth by the analysts, 8.2%. Industry, a negative 2.4%. Company also pays a nice dividend of 3.1%, only using 13.5% of their earnings to pay that out. They have increased that dividend by about 10.4% over the last year and 13.9% over the last 5 years. Taking a look at the balance sheet, current ratio 1.1 versus 1.7. That's okay. We'll accept that because the debt to equity is only 0.5, far below the industry at 1.7. So you want a higher current ratio, lower debt to equity. So we got that mostly on track there. I like that. That's okay. And I love this net profit margin, 20.2 versus 16%. Return on equity, 29.7 versus 21.9. Gosh, I everything on this looked good so far. Chase, what do you got? You got to spoil the party here or what?
Well, I haven't looked at the numbers necessarily going forward just yet, but because I was curious what the company did, just a little more detail, is they actually were created as a result of a merger between Potash Corp and Agrium. Nutrien is now the world's largest fertilizer producer by capacity. They actually produce the three main crop nutrients: nitrogen, potash, and phosphate. Again, although its main focus is in potash, it's the global leader in installed capacity with roughly 20% share. And they also do sell as an agricultural retailer in the U.S. They sell fertilizers, crop chemicals, seeds, and services directly to farm customers through brick-and-mortar stores and online platforms. Also found this interesting. They are headquartered in Saskatchewan, Canada.
Oh, wow.
Yeah, so are not a headquartered in the U.S., but that's always stood out to me because from the movie Grown Ups years ago, there's a scene where the lifeguard says he's from Saskatchewan, and I was like, I'd never heard of it before. That was the first company I've ever seen, I think, from Saskatchewan.
We should go on vacation and check it out.
So, little side note there, but that would be a little interesting. But current price here for Nutrien is $68.01. Wow, 52-week high, $117.25, and the low is $67.52. I see year-to-date down 6.2%, and the one-year return down 31.1% as well. Going forward, though, for the business, I got to December 2024, I do see estimated earnings per share here of $8.07. That would give us a target sell price of $133.96. Looks very attractive. I will point out, though, the earnings have been declining quite severely. In 2023, it's estimated that they'll decline by about 29%. 2024, estimated to decline again about 13.5%. And I do know that the potash and agricultural kind of department was doing very well. I think it was the beginning of last year. And I think there was a lot of demand pull forward. I think all the kind of input costs and stuff was very favorable. I think things have kind of started to reverse course. So the numbers look very good, but I worry it could be almost like a value trap potentially as well.
And actually, I was just thinking, you said the earnings were about $8 a share.
Uh-huh.
They drop another 20%. That would give you, about $6.40. You would still have, I think, a good target sell price.
You would, but if they continue to drop in the coming years as well, that stock price could not go up because you could have a good target sell price, but that's what I'm saying. It could be a value trap because if the earnings continue to decline over the next 5, 6, 7 years, you're going to be, instead of growing into a higher multiple, you're going to be declining into a higher multiple, essentially.
And I guess the important part here, Jim, is to understand is why are the earnings declining? What is going on here? Because this could turn around tomorrow or 6 months or even a year, and you could see the stock price continue to fall, but if you're going to figure out why those earnings are falling, because this company looks very good. I thought maybe because of the combination, you'd have a high, intangible assets. That wasn't the case. I looked at the price to tangible book value, 3.1, price to book 1.3. So there's not a lot. I can't find anything wrong with this company.
I will tell you, I think it has something to do with energy. I believe that there's either a large amount of like natural gas or some type of oil or something that goes into the phosphate making process that is driving up the cost of that. Potentially, this is again an estimation here, but if that is the case, I think that's a positive because while the energy market I think remains troubled over the next year, maybe 2 years, it's not going to remain troubled for the next 5, 10 years.
Right. I think this is definitely worth the research, and again, this company is Nutrien, symbol NTR. Jim, I think you stumbled onto something. I think there's more research to be done on it, but I think it's worth it. And I would just want to find out, and how much of petroleum or natural gas does it take to do this? Because it could be an overshoot. But I like this business. It's one of these businesses that I like with the fertilizer, stuff like that. It's not going to be, don't need fertilizer anymore. Can't be replaced by technology. So I like it. Jim, you found a pretty good one there.
Okay, thank you, sir.
All right. Well, you have a good one. Thanks for calling.
Thanks. Bye now.
Bye-bye. All right. That opens the phone line, 833-288-0973. That's 833-288-0973. I just like seeing companies like that. It's just
Yeah, gosh, I think it was at the beginning of like last year or something. I just remember these potash companies, they were just like on fire. Remember they like started the year up like 60%, and I don't remember if it was last year or the year before. So I think now is potentially time. I mean, this has been cut in essentially half compared to its 52-week high, pretty close to that level. Right. I mean, that to me provides a good amount of like downside risk there to it. So I mean, there's definitely a lot of positives, but as you said, as we always recommend, you got to just do a little bit more research to see, well, there's a reason why it's down close to 50%, essentially. Right. Why is that reason? And is it fixable is the big question.
Fixable. And again, you could buy it at 68. It could go down to 50. But where's it going to be 2-3 years from now? Because, again, it's just a good basic business. Not a lot of intangible assets. I mean, not a lot of debt. I mean, there's just so many good things. You collect, what was the dividend? 3.1%, I think it was. I would not mind seeing this in our portfolio based on what I see. More research to do, but yeah, this is a good basic business. I like a Nutrient. Is that how you say it? Nutrient?
Nutrient, yeah.
Nutrient, NTR is their symbol. All right, phone number's here, 833-288-0963. That's 833-288-0973. Let's head up to Oceanside and speak with Tim. Tim, you're on the Smart Investor, Brent and Chase. How can we help you?
Hi, Brent and Chase. I wonder if you could tell me about Ford, and specifically if you feel that dividend is well covered or not.
Okay. I haven't looked at Ford in quite a while, so let's take a look at Ford Motor Company. Their symbol is F as in Ford. I think it's one of the few that still has a single letter symbol out. I can't think about any
T.
other. Oh, man, team. Okay. All right. Yeah, you're thinking about them now.
Yeah.
All right. Well, let's look at Ford here. The symbol again is F. Not much on the short side, 3.8%. I'm surprised on this. Only 52.7% institutional owned. I thought that'd be much higher than that. We do see no PE ratio because of the last 12 months. They have no earnings. The industry was at 11.5. We do see a price to tangible book value 1.1 versus 4.0. And I will point out that's the same as a price to book. So they have no intangible assets on their balance sheet. That's a surprise to me. I think all the other car manufacturers probably do. Price to cash flow 7.2, above the industry at 6.8. No PEG ratio. The industry does come in at 4.5. Over the last year, no earnings growth, but sales are up 17.4%. Not quite as good as the industry growth at 22%. Unfortunately, the 5-year earnings per share estimated growth from the analyst shows a negative 11.7% for Ford, but a positive 5.8% for the industry. They do pay a 4.9% dividend, which is very attractive. No payout ratio because they are borrowing to pay that out currently with no earnings. We do see that the balance sheet current ratio 1.2 versus 1.5. That's okay. Debt to equity 3.3 versus 0.7, which is concerning. But many times with car companies, you have to be careful because they do finance the cars for the customers, and that can kind of throw off the balance sheet. So that's not always all their debt. We do see a net profit margin of a negative 1.2% versus a positive 5.8%. Return on equity a negative 4.6% versus a positive 14.6%. And Chase, while you're doing your thing, I'm going to look at the cash flow statement, see what the cash flow looks like.
Yeah, current price here for Ford, $12.33. 52-week high was $16.68, and the low, $10.61. I do see year-to-date up about 12.6%. And going forward for Ford to December 2024, I do see estimated earnings per share here of $1.74. That would give us a nice target sell price of $28.88. I mean, it trades at a very attractive multiple of about 7 times. I will say, though, these consumer cyclical stocks, I mean, generally they have lower multiples, like just by the nature of their business, because their business is so cyclical. So generally during boom times, they're going to have lower multiples, and then during downtimes, their multiples will expand, not because it's good, but because their earnings shrink so much during difficult time periods. So it is something to kind of keep an eye on. The multiples always look quite attractive for these businesses, but it is kind of something you got to really understand and dive down deep into if the business is worthwhile investing into.
And also important with a dividends and cash flow. So they go to the cash flow statement. Now, also we have a December 2022. These were for the quarter. They did have positive cash flow of $1,178,000,000. Looking at their dividends paid, that does cover the dividends, but it is the worst cash flow over the past couple of years. They did have in March 2022 a negative $1 billion there. But usually, like in September, it's $3.8 billion. June 2022, $2.9 billion. December 2021, $3.5 billion. So their cash flow seems to be slowing down. I know they're spending a lot on the EV side, is perhaps where their cash is going.
And they also have restructured to kind of implement new business units to give a better idea, I guess, of how their EV business is doing. So generally with restructuring, sometimes there's going to be one-time costs and so forth associated with that. It could be something that is occurring for maybe the next year or two, and then it falls off. So that is, again, something that you'd probably want to understand. And also with the kind of tilt towards EVs is obviously they're investing a lot of money in there. What's their payoff looking like? Obviously, they got the Ford F-150 Lightning. They have now the Mustang Mach-E. But I was surprised. They actually fell quite substantially in the first quarter for EV deliveries. They were like number 2 last year, and then they slid all the way down to number 5. Obviously, Tesla's number 1, but GM took the number 2 spot, and I think it was Hyundai came in at number 3, and then there was Volkswagen at number 4 and Ford at number 5.
Wow, I am surprised on that as well. But to answer your question there, Tim, I don't see at this time a problem with the dividend. I think Ford will continue to pay that dividend. They've done that for many years, except when they get real financial difficulty. They're not there yet. I think they would want to hold that dividend as long as they can. So answer your question, no, I think the dividend will be fine for a while.
My concern comes more from the growth of the business. I mean, how are they going to compete in this space? And if things slow down, generally car companies do struggle.
Yeah. All right, Tim?
Yeah, thank you very much for that info. Very helpful.
All right. Well, thanks for calling. You have a great day.
You too. Thanks.
Okay. Bye-bye. All right. That is open on the phone line, 833-288-0973. That's 833-288-0973. And I do want to mention again about the workshop coming up. It is going to be Thursday, April 20th at 6 o'clock in Scripps Ranch. You're going to learn a lot of information there. You hear us go over these numbers here, how we think about them. And just think about this. When we go over these numbers here, we spend probably, I'm going to say, 4 minutes or so analyzing numbers. In the workshop, we spend about an hour teaching you everything we do. Also, too, I have our financial planner there as well that's going to be talking about financial planning and taxes and so forth. So we spend a lot more time helping you understand how we manage not just our clients' money, but our personal money as well. So it's a great workshop. You'll learn a lot from there. But you got to sign up for the workshop. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And don't let the concerns right now, the economy, say, well, I'm going to wait until things get better. No, this is when you got some great opportunities, but you got to learn how to find out what those opportunities are and how we do it. That's what the workshop's for. Again, smartinvesting2000.com is where you can sign up there. All right. Phone number is 833-288-0973. That's 833-288-0973. 0973.
And we do take emails as well, and we did get an email actually this morning from Richard, and we'll go through that for him here. He says, good morning, been listening to your show for several years now. My parents have been very successful in their lives, now in their 80s. They're passionate about their stock portfolio. For the past year, I've worked to engage my parents in your investment principles, and ultimately we might share together. From that conversation, my mother provided me with one of the stocks she is most enthusiastic about and was extremely curious about your opinion. They hold shares in New Mountain Financial Company. That's NMFC. Again, New Mountain and NMFC is the ticker symbol there. Be grateful if you would review this Saturday morning, perhaps while waiting for your callers. I will be listening, and as always, look forward to your opinion. Happy Easter, Richard.
All right. Well, let's take a look at New Mountain finance. I'm very curious what this does. I'm sure you'll pull it up. Well, I'd say actually an asset management is what it is. They have a 2% float on the short. Not bad there. Only 44.6% institutional owned. PE ratio 16.3. That compares to the industry at 70.5. Price of sales 15.6. That's above the industry at 4.7. Price of tangible book value 0.9 versus 14.2, and that's pretty impressive because that means you're paying 90 cents on the dollar for the tangible assets of this company. But price of cash flow not looking good, 39.8 versus 10.4. PEG ratio looks good, 5.6 versus 12.4. Now something's going on with this company because over the past year, their earnings fell by 58%. I do see the whole industry down 48%, but their sales are also down 53.5%, industry down 37.5%. They have a 5-year growth rate of 1.5% versus 4.1%. I think what attracts people is a dividend yield of 10.6%. They use 162% of their earnings to pay out that dividend, so that is not sustainable. We do see here on the balance sheet, we've got a current ratio of 1.2 versus 2.8. That's okay. Debt to equity a little bit on the high side, 1.5 versus 1.4, and I'll accept 1.2, 1.3, but 1.5 gets me a little bit nervous. Net profit margin, well, that's kind of strange, 83.9% versus 9.4. Return on equity 5.7 versus 5.2. So not really thrilled about this so far unless you have something. You got that wrinkled look on your face like,
I was looking at what the company does. It's a closed-end, non-diversified management investment company, so they invest in equity interests such as preferred stock, common stock, warrants, or options received in connection with debt investments or may include direct investment in the equity of private companies. One reason their earnings could be declined is maybe a write-down on the balance sheet from some of the decline in the investments. Just kind of speculating on that. I mean, I'll just kind of say generally I don't really like companies like this because it's hard to kind of wrap your arms around what are they providing. It's not like a bank where it's easy to understand the loans and the assets they have. I mean, this is a little bit more complicated of a business structure to get involved with. But looking at the numbers again for New Mountain Finance Company, it's $12.06 is the current price. 52-week high is $13.76, and the low is $11.09. I see year-to-date it's up about 0.2%. I would also be curious on that dividend if it is consistent or if it kind of fluctuates up and down based off of how the company is doing. So that's something I'd be interested in. Going forward, though, go out to December 2024. I do see estimated earnings per share of $1.44. Would give us a target sell price of $23.90. So, I mean, the numbers look good on it in some aspects, but again, it ultimately comes down to, do you understand the business structure and what this company does? If not, I would say it's not even worth the time of owning it because we like to understand the companies that we own.
And this is hard to understand. I think you said they make their business from investing in stocks, preferred stocks, bonds, and so forth. And just like, you can't really, I want to own a business that I can understand what their concept is. They're selling chicken. Okay, I can understand that. We talked about the fertilizer. Okay, that's a good one. This one here is depending on what they're doing, what they're buying. Also, too, are they leveraging it? Are they trading with options? I mean, there's so many different things that you can really mess up on this company. I don't like confusion, I would say. And I think what's attractive is that 10% yield. But we know other businesses that you can get that yield on right now. Actually, Reed saying get that yield on that you can see what they're doing versus this one here. Reminds me of a SPAC a little bit.
I was going to say SPAC, or also too. I mean, this is a similar situation where all of a sudden things could be fine, and then you could go Silicon Valley Bank and blow up and be like, "What happened?"
Yeah.
Well, if you don't know what they're investing in, all of a sudden things could be fine. If they're over concentrated in doing debt financing or having preferred shares or the common shares in particular companies in one particular space, all of a sudden that industry blows up. This company's done for. So there's a lot of research that you would have to do here because things could turn very quickly and head south, and all of a sudden you'd be left with something that's worthless.
Right. So yeah, I hope that helps out, but we're not a fan of this one at all. I would definitely say if you have it, I would put a sell on it and say buy something that's more of a business.
Yeah, it's just the understanding of it is the big question mark.
I do want to talk about, because we teased with on the fact checkers. So Randy in Kansas, be patient with us here because we said we'd talk about this, and that's the fact checkers because we continue to worry about people's over-reliance on the internet technology and even more so the so-called independent fact checkers. We recently did a post on the JOLTS report, and it was flagged for false information. When clicking on the reason for false information, Facebook indicated it flagged the post because there is no record of Martin Luther King Jr. saying, "Our lives begin to end the day we become silent about things that matter."
And this was according to AAP Fact Check. And we talked about the JOLTS report already. If you noticed, it did not contain that quote or mention Martin Luther King Jr. at all. So it's just a very strange thing. And as I said, we had people comment on it. We kind of commented on it. And Facebook never fixed it. And It's like, it's just frustrating. But, just as a society, I believe we need to really emphasize critical thinking and doing more than just surface-level research that relies on algorithms, because clearly that's what probably Facebook did, is some algorithm marked us as partially false. But I don't even know how we got registered for Martin Luther King or that quote that we mentioned. Makes no sense.
Yeah, and it's just something that you have to realize when you read the post and everything. And actually some of the comments said, well, we know you guys, have good factual information, but Facebook did not. And I don't think it was flagged on LinkedIn or
I mean, gosh, you're going to have to flag the Bureau of Labor Statistics if that's the case. I mean, it's crazy.
Yeah, it's just very interesting. And so we just want to bring that up to be careful. And again, they've gone to the other side because before you can do almost anything, now they're checking things and saying, and was frustrating is we can't fix it. We can't say, no, this is not correct. And anybody that reads the reason why, they're going to say the same thing. Martin Luther King, what are they talking about a speech? It had nothing to do with that. So just very frustrating.
I remember we had this happen another time as well on Facebook. We did a post about 5G, and this was years ago, and it was flagged for misinformation. And again, it had nothing to do with the post. And it's very strange.
Yeah. So we just want to point that out. It doesn't happen very often, but we want to point that out.
And the reason
JOLTS report was good information.
And the reason it's so important is just because people they just do that surface level now, where they'll read headlines, they'll pull things from Facebook and say, "Oh, they have bad information. It's false." And it's like, no, you got to actually read things and dive deeper into it and do the research, not just read the headline, because that's where you can go way wrong.
And one thing that I've kind of realized now, there's a lot of information out there, but there's a big lack of wisdom, and that's what people need, is more wisdom and critical thinking to really go through this stuff. All right, let's go out to, or back to, as I said, I promised to go to Kansas and speak with Randy. Randy, good morning. You're on the Smart Investor Show. Brent Chase, how can we help you?
Good morning, Brent. Good morning, Chase. How you guys doing?
Good. Long time. Haven't heard from you.
Yeah, it's been a little while. I still listen to you guys every week. I just haven't called in for a while.
It sounds like you're picking up a southern accent out there.
Well, you never know. Hey, glad to hear you guys are partners with the Padres. They're kind of my National League team, even though I'm a huge Royals fan. But I always root for the Padres. Oh, damn, my dog's getting crazy here.
Yeah, your dog wants me on the radio, anyway, too, it sounds like.
I always root for the Padres when it comes to National League teams.
Right.
Anyway, hey, I've got I've owned Foot Locker for a couple of years now. Boom. Sorry, guys.
No worries.
Anyway, I've owned Foot Locker for a couple of years. It's had a nice run up, but I've kind of been noticing you guys are a little down on retail right now. Mm-hmm. I know you went over Kohl's last week, and I'm real happy with Kohl's, and I see a lot of these shoe manufacturers that are opening up their own stores and things. I'm just wondering, is Foot Locker still maybe something worth holding? I've made money on it, but I'm thinking about selling it. So see what you guys think.
Yeah, let's take a look at it, because they are a retailer, and we've talked about this before, because they sell Nike, which you can get online. They sell Under Armour, you get online. So, I mean, it's one thing that we kind of look at, that, what value are they adding? So we're going to take a look at the numbers, and we'll talk a little bit more about it as we go through it. Again, company is Foot Locker, symbols FL, in the apparel retail industry. Fairly high short on this, 12.4%, usually above 10. I can start saying, there's a little bit high there. We do see that the PE ratio does look good, 11.2 versus 25.8. Price to sales, 0.4 versus 1.8. Price to tangible book value, 1.8 versus 27.6. That's a positive. And price to cash was expensive, 22.3 versus 18.6. They do not show a PEG ratio, which is disappointing. Now, we do see, and this is surprising to me, over the past year, earnings fell by 58%. Industry down 4.9. So I want to know, why did their earnings fall by 58%? That's a big fall off there. Their sales were down 2.3%, but the industry was up 18.4. So why are their sales going down, industry not going down? Could be a problem here. Another problem, wow, 5-year earnings per share growth rate estimate, a negative 15.2% for Foot Locker, but a positive 7.5% for the industry. So that doesn't say anything good. You do get a nice dividend here, 4%. They use 44.2%. They're going to pay that out. We do see on the balance sheet, current ratio 1.6 versus 1.8. That's good. Debt to equity 1 versus 1.1. We also see a net profit margin 3.9, not as good as the industry at 6.7. And return to equity on the low side, 10.4 versus 27.6. We like to see at least about a 15% return on equity. Chase, what do you got?
Yeah, well, looking at the current price here for Foot Locker, it's $40.43. 52-week high is $47.22, and the 52-week low, $23.85. Year to date, I see the stock's up 8.1%. And I remember, if not last year, a couple of years ago, I think there were some issues with Nike, and that's when the stock kind of plummeted. And I remember kind of looking at it saying, oh, it could be interesting, but it looks like it has recovered from those levels. But going out to January 2025, I do see estimated earnings per share of $4.17. Would give us a target sell price of $69.22. So again, the valuation looks very good. But the other strange thing, as you talked about the earnings declining about 58%, it looks like in 2024, since they report on a fiscal basis, they're also estimated to decline about 29%. So hopefully this is kind of trough earnings for them and they can kind of build back out of it. But with that, my question is, what's kind of the encore? You know, what are they going to do next? Right. I mean, that's where the issue kind of ensues, where if Nike's like, we don't really want to go to Foot Locker anymore, this company could have major issues.
And Randy, I assume they have Foot Lockers out there in Kansas. Do you go to one there at all?
They're out here. They're in the malls. We've got malls where, and I don't go to malls, but I know they're still in there. But yeah, I don't know that I've ever really been to one that I can remember. But
yeah, because
I kind of got in back when you were talking about when the 52-week low was around 23, 25. I got in about then when they were having the issue with Nike. And so it's had a nice little run up, and I've collected pretty decent little dividend over time. But I just started getting a little bit concerned when you guys were kind of down on Kohl's and retail overall, and I thought, you know what, I better call them and see what they think about this.
Yeah, and you do collect
negative to me after you guys went over it. So.
Yeah, and you collect about a 4% dividend, but I just, as Chase kind of said too, I just don't see a big growth factor for Foot Locker going forward. You've got a nice profit on it. Yeah. I don't go in Foot Locker. I don't know anybody that goes in a Foot Locker. I'm sure people are going in there, but I feel it's more of a declining business than a growing business. I just,
and I could be wrong. I could be, but this is just kind of the surface level research. But if you listen to the conference calls and stuff, the management might talk about their growth plans, and they don't always make sense. And if they don't make sense, then I would stay out of it. But if they're doing something to generate growth, maybe it is still worthwhile to hold.
Yeah, I mean, if you came to us and said, okay, we want you to manage our money, we would sell Foot Locker. So,
okay,
does that help you out?
That's kind of here because I'm up about 50% on it right now, and I'm thinking I'll just cut my profits out and go find something else.
Is it in a retirement account or a regular account?
It's a retirement account.
Oh, so no taxes due there.
Yeah. No tax ramifications. So
yeah.
Yep.
Well, good. Well, congratulations.
All right. Well, hey, good. We'll talk to you later.
Okay, Randy. All right. Bye-bye.
All right. Bye-bye.
All right. That does not open the phone line because we only got like about another minute left here. But gosh, a great show. Some good things we had here. Good conversations. Good companies that we found, and I want to mention the workshop. That's what I want to do because the workshop is important. The workshop, again, is coming up on Thursday, April 20th at 6 p.m. in Scripps Ranch at our office there. It's going to talk about how you should be investing now, will there be a recession or not, and how you invest during that recession. What do you do if it does happen, or if it doesn't happen? Well, the workshop, again, will be April 20th at 6 o'clock. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Thank you for listening to Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And be sure to visit that website, smartinvesting2000.com. That's smartinvesting2000.com. Have a great day. We'll talk more next week right here on the Smart Investing Show.
amusing to think